Good evening, everybody. Unfortunately, we've got some good news and we've got some bad news. Bad news is Harry has a family emergency tonight and he's not going to be able to make it. The bad news is that I'll probably, if you want, I can do about 30 minutes of showing what patterns are working well and why some of these some of our picks are working well. The good news is that Harry works with Gilburt, and he is trying to get to a computer right now as emergency catch up, and so he's going to be coming on at around 30 minutes into our session. So he's going to be talking on Elliott wave, but I think using Fibonacci numbers. So I hope that doesn't whack people too much as far as disappointing. You're going to get stuck with me here for a little bit. But anyways, yeah, this is one of those situations where family emergencies need to be taken care of first. So, anyways, okay, that's just because you like the jokes, Jimmy. All right, so it is 8 o'clock, so we'll get started. As we can see, this market is in a nice steady uptrend. No indication, and the Japanese race traders say, let the market tell you what the market is doing. As we can see, after the reversal of this Morningstar signal in the Dow, it traded above the T-line, pulled back, came back up above the T-line, pulled back, up above the T-line. We're probably still in an upward trend here for a while. And the NASDAQ, same scenario. It pulled back, and then notice how once it got back up into its trend channel, it traded right back up again. Pulled back. Now we're probably right back up into this trend channel. Could be a steady uptrend. There should be charts. Jim, Jim, if you could help, who had no charts, GW. And Mark R is having a problem with charts. All right. T-line is the 8 exponential moving average. This is the most important one. If you see a candlestick buy signal and a close above the T-line, you stay in until you see a candlestick sell signal and a close back below the T-line. I'm going to run through the other commodities real quick. Crude oil bounced up a little bit today, but still not up above the T-line. However, it's in the oversold area and did an island reversal. If they can open this positive, I would bet you donuts are going to bring it back up to the 50-day moving average. The 10-year note, that's not quite as good as, but it's still in a much upward trend area. So interest rates, it took a whack today, but interest rates should be interest rates should stay down here for quite a bit yet. What else are we looking at? Cattle, I had to reverse the positions. I am now short. Oops, where did it go? GLEJ. As you can see, we've got these various J-hook patterns. So right now, cattle is on the downtrend. And gold trying to bottom in here. As we can see, we've got a few days where it's bottomed. Now we did a Morningstar type signal. Let me make this a little bit bigger where we can see it. Oops, I'm sorry, it closed below the T-line. So we're still in a downtrend. And silver, Silver also it's just above the T line, but looks like it closed right back down on it. So we're probably still in downtrend on the metals. Natural gas staying above the T line, and look at the T line squeeze, pushed it up through the 200. So there's probably more upside to this one. Okay. Yeah, very simply stated, Andy, if you see a candlestick buy signal and a close above the T line, as long as it does not close below the T line, you stay in it. All right. Some of the ones that we've recommended recently, we'll look at and give the why and wherefores. Santa. Notice how it was in a downtrend until we had an inverted hammer and then a close back up above the T line. The next day they gapped it up. We're in this one on the positive open a few days ago, doing a double doji. Now, a double doji is where they pull it back, but the benefit of candlestick signals is it's telling us it's not a very decisive pullback, which means it's probably just profit taking. Allows for a very high probability trade. If it opens positive tomorrow, they're probably taking it right back up again, probably the same magnitude as that candle right there. And if they do, that means they're probably pushing on the 50 or even going through the 50. TIVX was recommended today for one very important reason. It was a kicker signal. Now, it didn't execute today because it didn't open positive, but notice it did a doji. And Brenda, you can use all this information in here for trading Forex. You can use it for trading commodities, bonds, stocks, tulip bulbs, anything that has fear and greed in it. Candlestick analysis is merely the graphic depiction of what's going on in investor sentiment. Options, yeah, you're analyzing the underlying entity, and then you're putting your option trade to it. The gray line is the 20-day simple moving average. The blue line is the 50-day simple moving average, and the dark red line or the big red line is the 200-day moving average. All those are simple moving averages. The reason they're on here is basically because every single money manager in the world has these moving averages to make their decisions for their portfolios. We have the benefit of seeing exactly what's going on at those levels. Gray line is the 20-day simple moving average. So we had a doji today, and TBIX after a kicker signal makes this very simple. If this opens positive tomorrow, you buy immediately because you probably have a doji sandwich. Doji sandwich is a big move to the upside. A doji, if it opens positive, remember our simple rule of a doji, it's going to move in the direction of how they open it after a doji. If they open it positive, they're probably going to have another day about the same magnitude as that day right there. Okay, we've been in MKTG for a while because we had a kicker signal. Now look at what it's doing, a 45 degree that's staying above the T line. ABMD is another one that we've been sitting with. It came out of this rounding slow curve and it's just stayed above the T line the whole way up. Now look at these rounding curves. That usually sends off a blast, and I've picked out a few more rounding curves, the slow curves, which are very high probability trades, high probability, high profit trades. Let's see, we had a kind of a slow curve here on our GR. We did got an April call spread, the 55, or what is it, 60, 65? I can't even remember. But this one, as long as it stays above the T line, it's going to be going in the right direction. What else do we have? Oh, making very good money in UNXL. Fry pan bottom, inverted hammer, bullish confirmation, not only for the inverted hammer, but above the T line. And as you can see, they can't close it below the T line. This is up 50% from where, close to 100% from where we bought it. Drag the vertical edge of the chart to the left. You should be able to see all the way out here. That's probably, if you're having problems, fix it on your screen. Just use the Y is the S in front of all symbols. Oh, that's how this system works. That for stocks, you put, if you're having problems with the symbol, you put dot S dot. That signifies stocks. We also recommended Z. Oh, okay. I'm sorry. All right. Here's another round. We recommended this one a few days ago. The slow curve. Staying above the T line. Good possibility they're going to take it up to the 200. OSIS has been making some very good money for us. Coming out of this slow rounding curve scoop type pattern. Once it comes out of these patterns, it's like a slingshot effect. And notice where the slingshot effect is occurring. It's when the stochastics are already up in the overbought condition. Much different from where the buy signals are. Now this was the buy because you had kind of a morning star signal closing above the T line, creating a scoop type pattern. So it just gave you good indications of when to be buying this trade. CZR is one that's been bannered about in the chat room. Also coming right back up. And notice the belt hold type signal. That took out a lot of sellers, keeping this uptrend in progress as long as it stays above the T line. And let me see what else. So the slow curve is just a high profit trade situation. Either it's going to fail right here, or if they sling it out, it's got a very high probability. This is ISIS. As soon as they break these out, there's big price moves to be made with them. Let's see. Just to go back a little bit in history here, because now it was over here. We were in this one. Slow curve, and bam, up 37%. So they're just high profit situations to be in. And let's see, we've got 30 minutes here. Okay, we got plenty of time. ANGI coming out of a slow curve. Notice the morning star signal bouncing up off the T line. Now they've gapping it up. If this opens positive, you continue to buy because it's going to be moving to much higher ground at this point. NLS, slow curve, popping it out to the upside. The slow curves aren't anything magical. All they are is something visual that you can look at and decipher that they're in a slow curve, ready to pop to the upside. This is kind of a buildup of investor sentiment. Notice that they're breaking out when the stochastics are already in the overbought condition. And let me see. BCEI. This one's just starting. Notice the slow curve has helped out with a little bit of this belt hold. Again, the belt holds wipe out a lot of the sellers, sop them up, and get them out of the way and start the next move to the upside. This one can still be bought probably on a positive open tomorrow. And S or CIG, S.CIG, another slow curve breaking out, more than likely. Notice how they got this big fry pan bottom and this little slow curve. They're more than likely taking it up to the 200 right now. We recommended ATVI within the last couple of days because of this slow curve. If they start breaking this out, if this is wave one, and notice how this started with a slow curve, breakout, moves up, another slow curve. All the slow curve is letting people rest and get rejuvenated and get ready for the next move to the upside. Nigel, I don't have any Forex charts. Of course, there's only about 6 of them, right? And let me just take a look here. What else do we got? PRIM. Slow curve. Notice a little gap up right now. Doji, doji, doji. When you have a series of dojis, that tells you there's lots of indecision. Now they've gapped it to the upside, tells you that's the decision they've made. Now we're sitting right here. If they open this positive, what's happening? It's confirming this pattern, plus it's breaking out through this level, tells you they're anxious to get into new high territory. Nile, this is called a T-line squeeze or T-line crunch. Notice how they came from down here, smack dab up to the 50. Pulled back, they couldn't close it below the T-line until they crunched it right up through. This tells us there's going to be a lot more upside because now you don't have the resistance anymore, the 200 or the 50. The T-line kind of pushes right up through that level or pushes the price right up through that level. SANM, slow curve, broke through the T-line. It's still got this gap to fill, still got more upside. But just the fact that when they were rounding this and opening it above the resistance level, starting to get some good price action. So essentially what we're doing is looking at patterns that have extremely high probabilities of telling you there's going to be more upside. This is UHS. Slow rounding curve, morning star signal. If this opens positive, there's a good possibility they can break this out pretty big because they're going to be up in new territory, no resistance. PVTB. Slow rounding curve. If they open this positive, where are they? They're breaking out into new territory. This is just a rest area from a strong uptrend. Starting, look where they started, kind of with a big, huge belt hold, tweezer bottom. Started this nice uptrend. Now, with any candlestick signal, the bigger the signal, the higher the probability that there's been a trend reversal or a change of investor sentiment. I don't use volume. Volume doesn't mean anything to me. We're not buying volume. We're buying price. Now, it does help as a added benefit that if you see on a big reversal day they have big volume, that usually means that a lot of stock has changed hands and there's new ownership, and it's usually the weak selling into the strong. What did we just do? PVTB. That one's a good-looking stock for getting ready for a breakout. And Owens, Illinois. Let's see. Bah humbug. OI. Another J-hook pattern setting up right now. Notice a little gap up today. Lots of J-hooks out there. I think if I can read my own handwriting. OAS. Nice J-hook. Notice how I bottomed out right here on the 50. This tells me wave 1, wave 2, starting wave 3, which wave 3 will be equivalent to wave 1. HNT, same scenario. Notice what happened down here is a basing. Doji, hammer, bullish engulfing. Doji, 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 then confirmation. They're taking it back up through the T-line. And ETFC, one we discussed today in the chat room. Oops, hold on. This might be Avi trying to get in. Hold on. speaker off. Yeah. All right, welcome everybody. Sorry for the delay. We now have Avi Gilbert with us. He works with Harry, and he was gracious enough to step in tonight. And without any further ado, I will let Avi come on, tell you what his background, and he's going to show you some techniques they use for better trading. Welcome, Avi. Whoops. Can anybody hear me? All right. Let's see. Avi, turn your speaker on. It's, well, you must have had it on because I was hearing you. Avi, try your testing again. All right, hold on. Okay, I can see he's working on trying to get his.
Okay, how about now?
Okay, I can hear you.
Okay, I think it looks like people can hear. Okay, we're good?
We're good. Can everybody hear Avi? Okay. Avi, welcome. Take her away.
Thank you so much. I'm just going to go through some background for everybody about what we do, where I started and what got us started in the business and what we do. Basically, give you some background about Elliott Wave, give you some background about Fibonacci, who he was, what he discovered, what he's left us, and how we combine the two to show you a trading methodology utilizing both an Elliott Wave and a Fibonacci structure that really is quite a safe, relatively foolproof manner in which to trade any market, stock, commodity, you name it. So let me get right into this. When I first wrote my first article that attempted to call market top, I didn't start with any small or obscure stock. I basically went straight for the mother of all tops at the time. It was back in August of 2011, and it was during a parabolic rise in gold when it basically had a vertical trajectory. If you remember at the time, every analyst under the sun was calling for gold to exceed $2,000 at the time. The only disagreement among the analysts at the time was basically how far over 2,000 that gold was headed. So the first article that I wrote attempted to do something that no one had successfully done for the year and for the half a year preceding that article, and that most weren't even daring enough to attempt. And basically that was to call an accurate top in gold. So in the face of this parabolic rally, I suggested to the financial community that based upon my 200-year Elliott Wave and Fibonacci pinball study, you may want to cash in your long positions as gold approached the $1,915 level. Well, clearly, the market call didn't initially go over very well in the forum in which I first posted this article. The response that I received was as if I was being laughed out of the room for making such a seemingly ridiculous statement. Some of the comments that were posted included technical analysis cannot be applied to the metals. You know nothing about markets or metals. And this one was the best. There is no way you can understand what's going on in gold by doing technical analysis. But when gold topped within several dollars of my target, I decided it was time to write additional articles on the metals. But all the fundamentalists started coming out of the woodwork to explain to me why technical analysis simply is useless and can't work, and only fundamental analysis works. And yes, this was even after I had just called the top in a parabolic rally within a few dollars of the actual top. So I did what every other person in my position would do. I continued writing further articles calling tops and bottoms in various major markets. Well, after the top call in gold and then in silver, the bond market, the S&P 500 multiple times, people started to take notice. But you think the comments changed much? Well, they changed slightly. They went from comments like, your technical analysis is useless, to much more logically substantiated claims such as, Elliott wave is only a form of voodoo. Elliott wave is nothing more than witchcraft. Elliott wave is no better than using a Ouija board. And believe it or not, yes, these are some of the comments that I received. And one of my favorites, this guy is simply lucky. So as the detractors continued to post more and more, let's say sophisticated comments, we went on to call more major tops and bottoms in many different markets, as we said before, including metals in bonds, the S&P 500, and most recent public top call in Apple. In fact, many of you may have seen last summer, may even remember last summer, when every analyst that you read was basically calling for Apple to head over $800 at a minimum. And many were even expecting it to be over $1,000 in the near term. And that doesn't even bring up the many analysts that have inappropriately attempted to call tops in Apple over the last year. But in August of 2012, I published a very simple article in MarketWatch in which I plainly stated the following. As for our larger perspective, with the expectation for a fifth wave extension, and as you see, we are expecting a near-term top on Apple with potential targets at the 693, 712, and 722 regions. After Apple hits this upper target range, I think we will see a sizable correction, which will likely take Apple back to the 500 region. So if you're an Apple trader, you may want to ring the cash register over the next week or so and prepare to reload at much lower levels. Well, as you know, Apple topped at 705 and then dropped directly to 505 before it saw any sizable bounce. But as they say in the old Ginsu Knives commercial, wait, that's not all. I followed that up with an article in November where I said, quote, truth be told, I would love to see it retrace as high as the 580s before beginning its fifth wave down. Unquote. I further updated that target top a week later and said, I quote, ideally, the 589, 592 level should be strong resistance, which I do not see us breaking through just yet. If Apple does reach that level, then we may see another drop that can take Apple as low as the 500 region. End quote. So as we now know, Apple had momentarily spiked to pennies over the 592 level and then strongly reversed to the downside as expected. So what some of you may be hearing me say is, how does this voodoo or witchcraft or luck work? And as I'm sure you've already surmised, it isn't based on voodoo, it isn't based on witchcraft, and it's not based upon luck. And no, I don't use a Ouija board either. Rather, it's based upon Elliott wave analysis coupled with a very strict adherence to Fibonacci extensions and retracements, which I lovingly refer to as Fibonacci pinball. So first let me explain what we're talking about with Elliott wave analysis. As many of you may not be familiar with it or may have reservations about it for whatever reason. Until the times of R.N. Elliott, the world applied the Newtonian laws of physics as the primary tool for stock markets. Basically, these laws provided that movement in the market was caused by outside forces. Newton formulated his law of external causality into 3 laws of motion. A body at rest remains at rest unless acted upon by external force. Second, a body in motion remains in motion in a straight line unless acted upon by an external force. And 3, for every action, there is an equal and opposite reaction. So the common belief was, and unfortunately still is, that a stock will remain in motion in a straight line unless something acts upon it like news or earnings to change its direction. However, as Einstein stated, during the second half of the 19th century, new and revolutionary ideas were introduced into physics. They opened the way to new philosophical views differing from the old mechanical one. However, even though physics has moved away from the Newtonian mechanical viewpoint, sadly, our financial market analysis has not. In fact, how often do you see good earnings come out for a stock, yet the stock tanks? Well, we justify that by saying that they, quote-unquote, sold the news. But it really leaves you with the reasonable question is, how do you know if good news will cause a good reaction in a stock or a, quote-unquote, sell the news event? Well, as we all know, most market participants are looking for the next piece of news that's supposedly going to move the market. So when they hear a positive news event being reported, they automatically assume the market will respond positively. But we've all seen markets sell off on positive news. And it has many market participants scratching their heads in disbelief, and it unfortunately causes a lot of losses in their trading accounts. In fact, I can no longer count how many times I've heard fundamental analysts claiming that a market rally or decline just doesn't make sense or is wrong based upon their fundamental analysis. I mean, how many times have we heard analysts state that the market is just not trading based upon fundamentals at this time? Just the other day, I was listening to a fundamental analyst on CNBC who was actually claiming that from a fundamental perspective, the transport market was wrong when it's been rallying of late. Well, but it never occurs to such analysts that maybe their analysis methodology is wrong. Maybe the markets don't move based on fundamentals. Well, think about it. Does it really make sense to use fundamentals to determine market movements if many of these analysts themselves admit that markets don't always trade on fundamentals? Could there be something else that's moving markets all the time rather than some of the time? As Elliot put it, quote, in the dark ages, the world was supposed to be flat. We persist in perpetuating similar delusions. Elliot urged that we move away from such misdirected analysis and view that external events affect the market only insofar as they are interpreted by the market participants themselves. And that interpretation is guided by the prevalent social mood internalized by the investor community as a whole. Therefore, the important factor to really understand is not the social event itself, such as the news, fundamentals, or the earnings, but rather the underlying social mood which will provide the spin to an understanding of that external event or information. During his tenure as the chairman of the Federal Reserve, Mr. Alan Greenspan testified many times before various committees of Congress. In front of the Joint Economic Committee, even Mr. Greenspan noted that markets are driven by, and I quote, human psychology and waves of optimism and pessimism. And take note, he didn't say that markets are driven by fundamentals. He very clearly noted that it was psychology and waves of sentiment that move the financial markets. This simple premise now explains why markets sometimes rise when seemingly bad news or fundamentals have been announced, and why markets go down when seemingly good news or fundamentals have been announced. When the social mood is within a positive trending wave structure, bad news is seemingly discounted, and only good news is seemingly focused upon. And the reverse is true during a negatively trending social mood. So is it really the news or the fundamentals that are moving the market? The answer is obviously no. It's the prevailing sentiment which interprets the news or fundamentals that moves the market. So let's take a look at an Elliott wave structure so that we can see how we track the movement of market sentiment. Now, Elliott theorized that public sentiment and mass psychology move in 5 waves within a primary trend and 3 waves within a counter trend. Once a 5-wave move in public sentiment is completed, then it's time for the subconscious sentiment of the public to shift in the opposite direction, which is simply the natural cycle within the human psyche and not the operative effect of some form of news. This mass form of progression and regression seems really to be hardwired within the psyche of all living creatures. And it's what we've come to know today as the herding principle, which gives this theory its ultimate power. But what gives Elliott wave analysis the true power to determine where those turns in public sentiment will occur is Fibonacci mathematics. So allow me to take a few minutes and digress a bit into who Leonardo Fibonacci was and the significant impact he left upon our world. After the fall of the Roman Empire in 476 CE, much of European advancement in mathematics and philosophy was either lost or it simply just remained stagnant. Although there's a different opinion among historians regarding the classification of the period after the fall of the Roman Empire, this period became commonly known as the Dark Ages. Among recent historians, the Dark Ages lasted until around the 10th century. But around 1170 CE, Leonardo Pisano-Bagolo, or more commonly known to us as Leonardo Fibonacci, was born to Guglielmo Bonacci, a wealthy Italian businessman. To give you some reference during which times Fibonacci lived, the Leaning Tower of Pisa was being constructed at the time. Now, while Leonardo was still quite young, his father was appointed as an official at a port east of Algiers in North Africa. It wasn't long until Leonardo was traveling with his father through the Mediterranean. It was during this period of time that Leonardo learned about the Hindu-Arabic numeral system and recognized that these numerals were simpler and more efficient than the Roman numerals being used in Europe at the time. It was not long thereafter that he published his famous book, Liber Abaci, the Book of Calculation. This book was a key turning point in European mathematics, as it introduced the European community to one of the greatest mathematical discoveries of all time, namely the decimal system, in addition to the numeric system which we still use to this day. This was considered to be the most important advancement in mathematics since the start of the Dark Ages. Also included in this major work, Liber Abaci, Fibonacci worked through a mathematical problem, which led him to the discovery of what we call today the Fibonacci sequence, which is based upon phi, or the golden ratio. Within this sequence, each higher number is the sum of the prior two numbers, and the ratio of any two consecutive numbers approximates 1.618, or its inverse, 0.618. The higher you move through the sequence, the closer you move towards the 1.618 to 0.618 relationship. The 0.618 number has been referred to as the golden mean throughout history. We also refer to this number as phi. Phi is a number which exhibits many unusual mathematical properties. It's also the solution to a quadratic equation. These concepts have been understood by the greatest minds of history, including Plato, Pythagoras, Da Vinci, Kepler, Bernoulli, Newton. I can keep going. Historic structures have been built by architects of the famous Greek structures, such as the Parthenon, based upon the concept of phi. And even as far back as the architects of the Great Pyramid in Giza, in Egypt, who recorded their knowledge of phi as the building block for all man nearly 5,000 years ago. What makes phi even more unusual is that it can be derived in many ways and is exhibited in relationships throughout the universe, such as proportions within the human body, plants, DNA, the solar system, music, population growth, and yes, what's really important to us, the stock market. Phi is the one underlying constant throughout all of nature and governs all the laws within nature. Before, such as Pythagoras, Plato, and Kepler, felt that phi was the key to the secrets of the entire universe. As an example of how phi is the building block within the human body, in the 60s, Drs. E.R.Y. Bell and D.M. Gomez dissected the architecture of the human lung and discovered a Fibonacci relationship in the formation within the bronchial tree. Others have discovered that the diameter of the bronchial tubes decreases in Fibonacci proportion. Another example is when Eugene Stanley of Boston University, along with researchers from MIT and Harvard, discovered that the physiology of neurons in the central nervous system also exhibited Fibonacci relationships. Further examples include the fact that the navel in the human body divides the average adult body into Fibonacci proportions. The neck divides the distance from the navel to the head into a Fibonacci proportion. The muscles in the left ventricle are made up of a series of spirals that repeatedly contract to a point that is approximately 0.618 of the long axis from the aortic valve to the apex, and so on, and so on, and so on. In fact, Leonardo da Vinci depicted the general external Fibonacci relationships within the human body of man in one of his most popular drawings entitled Vitruvian Man. In 1941, Eliot stated regarding the financial markets that, quote, "These Fibonacci ratios and series have been controlling and limited the extent and duration of price trends, irrespective of wars, politics, production indices, the supply of money, general purchasing power, and other generally accepted methods of determining stock values." In our own recent times, we've seen evidence that phi even governs man's decision-making. Social experiments have been done and conducted which resulted in price patterns based upon a mathematical standard that mirror those found in the stock market. In 1997, the Europhysics Letters published a study conducted by Caldarelli, Marcelli, and Zhang in which subjects simulated trading currencies. However, there were no exogenous factors that were involved in potentially affecting the trading pattern. There was no news, no fundamentals. Their specific goal was to observe financial market psychology in the absence of external factors. One of the noted findings was the trading behavior of the market participants were, and as you can see, quote, "very similar to that observed in the real economy, wherein the price distributions were based on phi." In a different study conducted by psychologist Vladimir Lefebvre of the School of Social Sciences at the University of California, Dr. Lefebvre came to the conclusion that, quote, "As you see, we may suppose that in a human being there is a special algorithm for working with codes independent of particular objects. Specifically, when his subjects were asked to sort indistinguishable objects into two piles, their decision-making within that process divided the objects into a 62-38 ratio. In other words, these individuals exhibited a Fibonacci tendency in their personal decision-making. Therefore, there is significant evidence that behavior and decision-making within a herd and on an individual basis displays mathematically driven distributions based on phi. This basically means that math decision-making will move forward and move backward based upon mathematical relationships within their movements. This is the same mathematical basis with which nature is governed. The same laws that were set in place for nature also govern man's decision-making in mass and on an individual basis. Now, we know that movements in markets occur within waves as discovered by R. and Eliot, and we know that decision-making and changes in trend are governed by Fibonacci mathematics and the properties of phi. So how do we apply this to our trading to generate profits? Well, this is where our contribution to the Elliott wave world comes in. This is something that I observe within the Elliott wave structure and have adapted it to a trading methodology which I lovingly call Fibonacci pinball. Since third waves in the Elliott wave structure are the strongest and most powerful of all the waves, it really is the ideal wave to trade. Furthermore, since third waves themselves have to be composed of 5 subwaves, it helps us determine how we trade this structure in a relatively low-risk manner. Let me explain. After the stock market or a stock finds a bottom after a correction, it begins a new uptrend. Such uptrends take the form of a 5-wave Elliott wave structure as represented in the charts you see on your screen. And since I hope most of you can count to 5, this general chart does not need much explanation. However, what I do want to point out is that each of the impulsive waves, waves 1, 3, and 5, are all comprised of 5 subwaves each. and waves 2 and 4 are comprised of 3 waves each. So effectively, each impulsive wave, the wave that moves in the direction of the trend, can be further broken down into a 5-wave structure ad infinitum. This is basically what we mean when we say that the market is fractal in nature. It means that patterns are self-similar at all different degrees of scale. Now, since wave 3 subdivides into 5 waves, and once we have waves 1 and 2 in place, it makes trading the rest of waves 3, 4, and 5 relatively easy to prognosticate in a standard impulsive wave. This is what I refer to as Fibonacci pinball, and allow me to explain. Once waves 1 and 2 are set up, we then set up our Fibonacci extensions based upon those first 2 waves. Since wave 3 subdivides into 5 waves, we can use the Fibonacci extensions to provide guidance as to how wave 3 will now develop. Wave 1 within Roman numeral wave 3 will often target the 0.382 or 0.618 extension, as you see on the charts in front of you. We will then see a pullback for wave 2 to the 0.500 or 0.618 retracement of wave 1. From this point, the market will usually target either the 1.0 extension for wave 3 of Roman numeral 3, as you can see on the left chart, or as high as the 1.236 extension, as you can see on the right chart. We will then see a pullback towards either the 0.618 extension or the 0.764 extension, depending upon which extension the market targeted for wave 3 of Roman numeral wave 3. In the case of the 1.236 extension, if the market were to break down below the 0.764 extension, about 70% of the time based upon my experience, this is the early indication that the impulsive pattern up will ultimately fail, and then the market will be coming down hard and moving below where the move began. But assuming the market maintains support at the 0.764 extension, it then moves up to the 1.618 extension to complete all of Roman numeral wave 3. From this point, the market will usually pull back in a Roman numeral wave 4 back to the 1.0 extension, and then begin a final 5th wave rally to target either the 1.764 or 2.0 extension to complete the 5th wave of the entire 5-wave pattern. Now, of course, this is simply a standard framework within which we track an impulsive wave structure through waves 3, 4, and 5. There can be further extensions beyond the 1.618 extension that wave 3 can target, which will most likely change the targets for wave 4 and 5 as well. But the purpose of this exercise is to provide you with a framework through which you can track most moves for any stock, any market, and any commodity a great majority of the time. But what makes this method so valuable is that it provides natural stops on the way up to lock in gains as each phase completes its upward trajectory. For example, once Roman numeral waves 1 and 2 complete, and you begin Roman numeral wave 3, your stop is placed just under Roman numeral wave 2. Our entry is usually on the retracement for Roman numeral wave 2, where sometimes we'll wait as long as wave 2 of Roman numeral wave 3 if we're a little more uncertain of the pattern. Now, as waves 1 and 2 within Roman numeral wave 3 complete, you then move your stop up just below wave 2 of Roman numeral wave 3. As wave 3 of Roman numeral wave 3 proceeds to the 1.236 extension, as you see on the right chart, you would then move your stops up just under the 0.618 extension. And as wave 5 of Roman numeral wave 3 moves towards the 1.618 extension, you should most likely take your profit, or at a minimum, move your stop up just below the 1.0 extension. What you're doing with this methodology is you're moving stops up continually to lock in gains while still allowing the market to continue within its bullish trend. The reason I say, by the way, that you should consider taking your profit at the end of Roman numeral wave 3 is because wave 4 is notorious for burning time in a long consolidation. This will clearly erode the time value that you have in options that you may trade. And since your target is the 1.0 extension lower, you can always re-enter when it gets closer to that target, and you won't lose any of the significant time factor within the options pricing. Now, these are some of the basics of Fibonacci pinball. And when you're able to master these basics, you'll be seriously amazed, and I'm continually amazed, each and every day, at how accurately you can predict and trade so many different market moves. In fact, it's so easy once you learn it, even a caveman can do it. So now that you know how, now you see how this general trading perspective works to target levels quite accurately, I can hand you all your own Voodoo course completion certificates once we're done. Now, if any of you have any further questions about how this works, and how we apply Elliott Wave and how we use this to track all the different beta stocks that you're seeing in the market or wherever you decide to trade, we offer a 2-week free trial. Don't ever hesitate to come by. It's free for 2 weeks. We have an incredible library. Right? What I gave you is a very, very basic understanding of Elliott Wave here, but we have a very, very detailed library, a whole bunch of different webinars to take you through the Elliott Wave basics from beginner all the way through intermediate. And we go through this on a daily basis in real time with all the different markets, S&P 500 real time, gold, silver, oil, futures, cash index, and we even do this with, I can't tell you how many stocks we review like this on a daily basis. So don't ever hesitate to come by, and it seriously is amazing to see how Elliott and Fibonacci left us with such an incredible tool to be able to predict more accurately than you could ever imagine the movements within our financial market. So thank you all for listening.
All right.
By the way, I'm seeing some questions about, how do you know how to trade, where do you get the wave 2 and so on and so forth. Guys, feel free to come to like I said, it's 2 weeks. You'll gain a tremendous amount of information, even if you decide not to stay. Nobody's forcing anybody to stay, but we have all this information on our website. And as you can see here, it's ElliottWaveTrader.net, and that's with 2 L's and 2 T's. And we have all these charts, these basic charts we have in our library. And what we do is we go through these exercises real time. And our goal is to support people in learning how to trade utilizing Elliott Wave, and also, giving you guys ideas about where we are in the market and what to look for short-term, long-term. So feel free to come check it out. I'm seeing a lot of people asking how do you see it, but we have a lot of information if you guys want to see. Sorry about that.
Javi, thank you very much. Thank you very much for stepping in at the last minute. A lot of good information.
My pleasure. Thank you.
And again,
thank you so much for having me. I really appreciate it.
Thank you. All right, everybody. Again, use whatever information you can put together that makes your own investing that much better. Everybody has some good systems out there. It's your responsibility to try to learn what systems work the best for you. So Avi has shown us some very good information. Take advantage of it. With that, we'll say good evening, everybody. Have a good night, and we'll see you all in the chat rooms.